Hey everyone, welcome back. Today I'm breaking down one of the biggest events on the Indian stock market calendar, NTPC Green Energy's lock-in expiry. If you're a retail investor or thinking about buying in, you absolutely need to understand what's about to happen and why it matters more than all the government contracts and green energy dreams you've heard about. Let's start with a quick background. NTPC Green Energy is a subsidiary of NTPC Ltd, a massive government-owned power player. Before its IPO in 2024, NTPC Ltd owned 100% of the company. Pretty straightforward. But even after the IPO, NTPC Ltd still controls about 89% of the shares. Retail investors like you and me, we're basically holding just 11%. So let's be honest, the promoter, NTPC Ltd, calls the shots. Retail buying and selling barely move the needle compared to the big boys. Now, here's the big news. On November 26, 2025, the one-year lock-in for those promoter holdings ends. And it's not some minor event, this is a tidal wave. A jaw-dropping 580.6 crore shares, or 69% of the entire company's equity, suddenly become available to trade. That's like opening the dam gates after months of heavy rain. To put it in perspective, as of now, NTPC Green Energy shares are trading at Rs 97.2 on the BSE, and the company's market cap is about Rs 81,900 crores. But here's the clincher. In 2025, the stock's already down 24% year-to-date. It's trading well below the IPO price of Rs 108, and a full 37% off its post-listing high. Now, you might be thinking, but this is a government company, it's safe, right? Let's look at history. Whenever a big chunk of locked-in shares hits the market, prices tend to tumble, even for great companies. Remember Ola Electric? When just 4% of its equity unlocked, the price dropped 8% in a day and hit new lows. Bajaj Housing Finance? Down over 6% in a flash after its lock-in ended. And Zomato? That's the poster child for post-lock-in crashes. Now picture 69% of NTPC Green Energy's shares becoming tradable overnight. Even if only a fraction is sold, the sheer supply can overwhelm demand, pushing prices lower, sometimes sharply and suddenly. But let's be fair, NTPC Green Energy isn't a dud. Far from it. Their order book is basically bulletproof. 32 gigawatts contracted, with heavyweight clients like SECI and Indian Railways, both government-backed. They're planning to pump Rs 1 lakh crore into wind and solar by 2027, aiming for 60 GW of capacity by 2032. Financials? Net profit up 130% year-on-year. This is a powerhouse business with the government of India as a customer. But here's the trap. A great company doesn't always mean a great stock at any price. Think about it like this. Ferrari makes incredible cars, but would you pay Rs 50 crore for one? Probably not. The value has to make sense. No matter how solid the business looks, if there's a tsunami of shares about to hit the market, even the best fundamentals can't prop up the price. That's the renewable energy trap in action. Great company, wrong price. If you want to dig into NTPC Green Energy's projects and contracts, I've dropped a link in the description. So, what should you do? Don't just buy into the hype. Pay attention to the timing, the technicals, and the history. Lock-in expiries have a nasty habit of catching retail investors off guard. Stay sharp, keep learning, and always do your own research before investing your hard-earned money. Thanks for watching. If you found this helpful, smash that like button, subscribe for more no-nonsense market analysis, and let me know in the comments. Do you think NTPC Green Energy is a buy, hold, or avoid after the lock-in? See you in the next one.